Good afternoon, everyone. My name is Hari Singh, and thank you everyone for coming out today. I'm the chair of programming for CFA Society Winnipeg, and before we begin, just a few housekeeping items. Everyone will be on mute. Their videos will be off, but we can turn them on and unmute you when the Q&A session starts. Please keep your cell phones on silent mode. We would appreciate that. Before we begin. We wanted to acknowledge that we are gathered here today virtually on Treaty 1 territory, the traditional land of the Anishinaabe, Cree, Oji Cree, Dakota, and Dene nations, and the homeland of the Red River Métis. We also acknowledge that the water we drink and use comes from the Shoal Lake Foley First Nation. CFS Society Winnipeg has served the Winnipeg investment community for more than 70 years by promoting ethical and professional standards within the investment industry. The society is an active participant and innovator with CFA Societies Canada and one of CF Institute's global networks of local societies. Today we have MFS with us to do this presentation, and the session will be moderated by Andrew Marshall, who's the managing director, institutional side, for the MFS, and he's responsible for the sales to institutional investors, including public and private pension plans, corporate investors, endowments, foundations, and insurers. Andrew joined the MFS in the year 2025 with previously 4 years of experience as the head of North American sales at Aviva Investors, 2 years as Senior VP of Client Service in Institutional Markets at Fiera Capital, 17 years as Vice President, Canadian Institutional Sales at Aberdeen Standard Investments. And he's also an MSc from Heriot Watt University at Edinburgh. So I will let Andrew take it over from here. Andrew, thank you.
Perfect. Thanks, Harry. Hi, everyone. Thanks for joining us today. We really appreciate it. Maybe just before I introduce our guest speaker today, I just wanted to touch base or talk a little bit about the format. So today's format, what we'll do is have our guest speaker give us a few minutes of opening remarks. And there, from that point on, we'll follow it up with a bit of a fireside chat, a Q&A chat, if you will. So we've chosen this format specifically because we felt it would give everybody an opportunity to ask their questions. We want to make this as open and interactive as possible. So please, as we go through the discussion, enter your questions into the chat. And what I'll do is, as we go through the discussion, I'll try and integrate those questions in. Now, if we don't get through all the questions, that's okay. We've also reserved some time at the end of the discussion for a broader-based Q&A. So hopefully we get to all the questions that'll be asked today. So now maybe a few words about our speaker. Mr. Rob Almeida is an investment officer and global investment strategist for MFS Investment Management, offering insight and perspective on cyclical and secular trends impacting investors. He serves as lead portfolio manager on multi-asset income and alternative strategies and is a member of MFS's fixed income strategy and fixed income risk and opportunities groups. Rob joined MFS in 1999 and served as an institutional portfolio manager for the fixed income department between 2007 and 2009. He joined the U.S. growth equity team in 2009 and became a portfolio manager in 2014. He added additional portfolio management responsibilities in 2018 and assumed his current role as strategist in 2019. Rob is a graduate of the University of Massachusetts and earned his Master of Science degree in finance from the Sawyer Business School. Rob, we really appreciate you taking the opportunity and coming out and speaking to us today. So maybe I'll pass over the reins to you now.
Thank you. Well, first, thank you, everyone, for joining and for having me here today. I'm most looking forward to the Q&A. Ultimately, I want to talk about what you all want to talk about. This is finance. This is economics. These are social constructs. There are no answers. The future has no facts. There's only perspective. And I think we all get better by hearing other people's views, particularly when they disagree with our own. So please don't be shy. So I'll start off with as Andrew mentioned, just some high-level comments, and I'll maybe frame it from the vantage point of, are we asking the right questions? I think the answer might be no. And I say that, one, because that's a historical pattern, right? Generals tend to fight the last war. As humans, we tend to extrapolate our most recent past and look out into the future. And that's not new. And perhaps, though, it feels more acute because technology, while I'm not sure if it's making us smarter, it's certainly making us more informed, right? There's a difference between knowledge and wisdom. Knowledge is just the aggregation of facts. Wisdom is knowing what to do with it. So we're all more informed, but are these leading to us asking the right questions? So to take a step back, why does this happen? I'm not a scientist. I'm going to pretend to be one for a moment. The human brain processes 74 gigabytes of information every day. So to put this into context, 74 gigabytes is equivalent to reading about 50 million pages of text or several thousands of books in a single day. So the most powerful data processor on this call right now is not the GPU running in your laptop or your desktop, but it's the 3 pounds of tissue in between your ears. So this remarkable capacity to run hundreds of algorithms, often simultaneously and subconsciously during the day, is why humans sit atop of the food chain, even though we can't run as fast as a cheetah or as strong as, say, a tiger or a gorilla. And this works great in our physical world, where there's clear and, let's call it, inarguable causes and effects. Water freezes at 0 in Winnipeg, boils at 100. That exists there, that exists in Boston, that exists in Tokyo, that existed 10,000 years ago. It'll exist 5,000 years from now. The sun will rise in the east, it'll set in the west. So these are immutable laws. And why, and our understanding of them is to how we're able to build all the things that we've been able to do. However, when we apply this logic into social constructs, political science, economics, finances, areas without immutable rules or laws, they start to break down, right? Because financial markets don't work like that. Markets are social systems. Outcomes, i.e., stock prices or business cycles, they're driven not by physical laws, but by human decisions, specifically people allocating capital. And this is important because our brains are hardwired to look for relationships. Right. So everyone knows that if you dump out a glass of water, the water will fall out, not some of the time, not most of the time, but 100% of the time. And when we start to look for relationships in economics and finance, it can sometimes lead to the wrong conclusions. So, for example, the biggest one is people draw linkages between economic growth and stock prices. Yet they're two very different things. GDP is a flow. Equities are a representation of wealth, i.e., profits. Not to say that the two don't affect one another, they do, but the correlation between the two is literally 0 over time. So the stock market is really just a function of one thing. It's profits, returns on capital. So the right questions, and hopefully, we'll get to that in our dialogue today, I think are largely around what will profits be in the future and how much will investors pay for that. Now, obviously, that's a function of the economic backdrop. It's a function somewhat of the war. It's a function of the cost of capital. It's a function of the regulatory environment. It's a function of so many things, but they're all weighted differently. And I think sometimes our human brains tend to emphasize certain data points and underemphasize others, right? What matters a lot more to, let's say, Tim Hortons profitability is how many cups of coffee they sell relative to the cost. That matters a lot more than, let's say, what's happening in Iran. Yes, of course, there's second and third derivative effects due to higher energy prices and food prices, but ultimately it's about what does a company do and how do they do it. So if we zoom out for just a moment and just think, what's the bigger picture? So let's maybe put away the Bloomberg terminal and get away from the day-to-day noise. What's the bigger picture? And that is, we believe we're in a regime shift. And that regime is going to create very different profit outcomes versus the last 15 years. So to give some context to it, from the end of the global financial crisis, so let's call it 2009, all the way until COVID, let's mark that as 2021, we were in a very specific type of regime. It was one where households decreased spending, banks decreased lending, and companies underinvested in physical assets. Supply chains were optimized for efficiency. Capital was given back to shareholders through buybacks and dividends. In other words, the world's business models, particularly in developed markets, most particularly in the United States, became asset light or capital light businesses. So the global economy was really harvesting capital, not planting it. That had very foreseeable economic outcomes in terms of low growth, low inflation, very high profit margins, and investors were willing to pay a lot more for that. What's changed? Pretty much all of it, right? So since COVID, since the Russia-Ukraine war, since the deliverance of artificial intelligence in 2023, the capital cycle or capital regime has shifted. One from of harvesting capital to one of planting it. So now companies are rebuilding supply chains because it was optimized for resiliency, it was optimized for profitability. Now it needs to be optimized for resiliency. Investing in depleted capital stock, rebuilding plant, property, equipment. And then on top of that, we're layering artificial intelligence. But AI isn't just a technology story, it's actually a capital allocation story, which we're going to get, Andrew and I are going to get into in greater depth. So to bring it all together, why does this matter? Well, the last regime, the one that ended in 2021, was about falling spend, right? Falling capital intensity that led to falling cost of capital, falling interest rates, and rising equity multiples, which favored non-discretionary investment portfolios. In other words, it didn't really matter what you own. Fundamentals were going up and to the right, profits were going up and to the right, stocks were going up and to the right. There was very little value for security selection. So passive was a massive outperformer over active managers. This is a lot different. Capital intensity is rising, input costs are rising, therefore capital costs are rising. And now, as we'll get into, I think you're going to have an avalanche of new supply of goods and services, i.e. competition by AI. That's going to be a very different environment where profitability is going to be challenged for businesses that have something that's more commodity-like or can be easily duplicated or substituted. And those multiples are going to compress and they're not going to be very good stocks. Conversely, businesses, and I think there's fewer of them, but have something that can't be duplicated, that can't be copied, that have something that people need, they value, they're going to pay for it. Those companies will be able to pass along those higher input costs, sustain some level of above average profitability, and be able to maybe hold their multiples. And those are going to be much better stocks. So in sum, 3 points. One, regime change. One of economic stagnation to economic reflation. One of declining capital spend to rising capital spend. And that drives very different economic and, most importantly, for our purposes, portfolio outcomes. 2, stock prices are always about who captures value versus who gives it away. You've got a new capital cycle spurred by AI that's going to create massive market share shifts, as you're already seeing in software this year. You saw it in apparel last year. It's going to start spreading to other areas, and that's really exciting from a stock picker standpoint. And then finally, now is not the time to overweight the past. I think now is the time to look to the future and think about what are the businesses that have terminal value risk due to all these factors, and we need to make sure that they're not in our portfolios. So let me stop there. Andrew, turn it back to you, and maybe we'll get started.
Sounds good. Thanks, Rob. So just a reminder, everyone, the chat is now open. So if you want to start asking your questions, Rob, the first one I have for you, you're talking about a regime shift, technology led, at least in part. So we talked about the period 2009 to 2021. I'm going to bring you back a little bit further in time. I often hear about people comparing and contrasting what we're seeing with AI now to the dot-com cycle of, or the dot-com led investment cycle of the late 1990s. Are we in the same sort of environment? Any differences here? Like to hear your thoughts.
Yeah, if you've seen one business cycle, you've seen one business cycle. If you've seen one bubble, you've seen one bubble. They're all different, but I think there's similarities and differences that are helpful. So I think about back then in the 1990s, the similarity was obviously a life-changing technology that requires significant capital investment. So the 1990s was an overbuild of hardware, specifically, ultimately, fiber. But 30 years later, we're utilizing that spare capacity that was built. So it just took us that long to work it off. So all that fiber and broadband that was built in the 90s, now what affords you the ability to, watch a movie on your phone while you're delayed at an airport. So that was about building expectations of future capacity. Today, the future capacity is here in real time in data centers, in chips, in power. So there's a parallel there. Where there's a difference, however, is the capacity to overbuild is constrained. So if you take the narrative I just shared, if I restate it a different way, in the 2010s, we didn't build anything, right? If you think about each business cycle, they end because something was overbuilt that needs to recess or recede. In the 2000s, we built too many homes. In the 1990s, we built too much broadband. In the 80s, it was too much commercial real estate, and so on and so forth. In the 2010s, nothing was built. So what's happening now, the bottleneck with artificial intelligence, unlike in the 1990s, is it's constrained by the ability to build a data center. So the wait list or the wait time for a GEV turbine is 3 years. So it's similar and different. So whether it's memory or power or construction, all these costs are inflecting up. So a lot of these CapEx estimates that you're seeing or hearing by the hyperscalers, and they keep jumping, I think a misleading takeaway or an incorrect takeaway that people have, well, that's just a function of massive enterprise demand for AI. Yes, my firm, everyone, other firms are adopting AI more, so demand is rising. But I think a big part of these increasing CapEx budgets by their hyperscalers is just how capital intense and how physically constrained, because again, going back to earlier, you got 1% GDP in the 2010s because nothing was done. Now, all of a sudden, we're resource constrained. So I think those are the similarities and differences.
So we're resource constrained, but if we look at the short term, what we're talking about here is effectively these bottlenecks that you're referring to. Does that get into this discussion about the circular nature of investment within AI? I mean, you hear a lot of people talk about, or a lot of negative press around that circular investment. These bottlenecks must be having a massive effect on that. It must be part of the negative outcome or potential negative outcome that we could see arise from those bottlenecks.
So I think the short answer is no. But your question is very important. So maybe let me frame it a little differently. So I think the 1990s was about building way too much capacity beyond our ability to use in the near term, and that's why the bubble ultimately burst. This is, we can't build the data centers quick enough. The bottleneck there isn't money, it's physical goods and physical labor. Where the circular financing comes in, it's related, but on a slightly different way. And that is, the AI models themselves are having a hard time monetizing the product that they sell. So if you think about, let's call it technology 2.0 or internet 2.0. So Google, Facebook, or Meta, Amazon, et cetera. What did these companies do in the last 15 years? On the back of the 1990s build out, you had a few companies come in and offer a better way to advertise or a better way to search for something, than say looking up a phone number in the phone book, or a better way to buy goods than having to drive to the store. And they had massive network effects. So these companies provided a value proposition that attacked huge addressable market. So they were wildly profitable because of massive scale. So Amazon went from having a negative EBIT margin 10 years ago to a wildly high EBIT margin just through the benefits of scale. Every time Netflix, as a for instance, gets a new subscriber, it's 100% margin because they don't have to pay to make a new movie, right? In this case here, every time you query and you generate a number of tokens, that uses compute, it uses energy, it uses capital. So I think a big difference in what's driving the circular financing is the cost or the price that they sell AI for, since it came out almost 3 years ago or 2.5 years ago, has fallen over 99%. The price is deflating. So while AI usage is going up, the price is deflating at a much, much faster rate. At the same time, the cost of building a data center, of delivering tokens, running compute, is so much more expensive than what they thought. And now it's going up exponentially because of all these bottlenecks. So I think the circular financing, it doesn't have a 1990s parallel per se, but where I think it's a symptom, or what I think it's a symptom of just how far greater expensive building AI is than what most thought, and two, how hard it is for one model to differentiate versus another. So the opposite of Internet 2.0, where you build it once, sell it a whole bunch of times, this is build it once, sell it once, build it once, sell it once. And it doesn't have that scalability like the prior internet companies.
Okay, perfect. So if we follow that same thread, that diminishing level of profitability, is there potential that we're going to see acquisitions? We're going to see some companies that really don't make it through the fold, or our prime takeout targets, maybe even further concentrate the number of players within the market.
Yeah. Yes, just strictly based on history. That's what always happens. So, back to my open where I asked, or I mentioned, are we asking the right questions? Another way to frame that is, it's not the economic cycle that matters. We focus so much on that. It's really the capital cycle. Where is capital going? What's it funding? So clearly, capital now is funding and constructing AI. You can think about it in 4 stages. So whether it was the introduction of air travel 100 years ago, the introduction of automobiles 120 years ago, the railroads 150 years ago, radio almost 100 years ago, about 90 plus. So when these new technologies came along, and they had clear societal demand. You had a supply-demand imbalance. New technology, low supply, massive societal demand. When demand exceeds supply, what gives is price. So very, very high return expectations for these new technologies. All of them had the same thing. Because we're humans, and because I think we are biologically attracted to high return projects and we're biologically repelled by low, you get a capital cycle. So capital starts funneling away from low return projects into high return projects, right? And we call that capitalism. And so what you're seeing now is, or what you've seen in the last few years, is the funding, most of it in private space, of software companies and technology companies looking to compete in this model space. And I think the circular financing that you referenced earlier is a symptom of how hard profitability is to achieve in this technology, not because the science isn't phenomenal, it is, but because the science isn't differentiated. It's not Coca-Cola or Nike sneakers. It's something far more generic than that. So to answer your question, the way the capital cycle works is there's a reason we don't have 120 car companies like you did before Ford. You just have a handful. I think similarly here, we're going to have just a handful when this washes out. I'm not exactly sure who that will be, not to segue us into a different area, but that's why we tend to lean towards companies who sell parts and services to all the OEMs, all the AI model deliverers, or all the automotive manufacturers, versus try to make a guess on who's going to be the 2 or 3 that survive.
Okay, perfect. Well, again, maybe if we continue on that theme, if we sort of pan back and broaden out our view across all industries and sectors, how do we think about AI disruption in general? So, are we going to categorize companies in columns of clear winner, clear loser, or is it going to be a lot more nuanced than that?
I think the answer is always somewhere in the middle, and I think it's far more nuanced. I think, and we've been talking about this in our technology meeting really since this began, which has been, who are the software companies that will not be fit for purpose in this AI driven world? Because if we simplify it, you can think of software just like you would a hammer or a screwdriver, right? It's CapEx. CapEx is just money spent on a tool to make an employee more productive. And where there was significant investment in the 2010s was in software. So the average Fortune 500 company pre this AI world, and I think the number still exists today generally, has over 600 software applications. So as AI gets onboarded, well, what is it? It's software, but with a brain. So software is just code, a set of instructions. If X equals Y, do this. If X equals Y, right? Whereas this now has the ability to do a lot more. So what we've been working on really since this began is, who are the software companies that sell something that AI can readily duplicate? Maybe it's more manual processing. So maybe if you're paying for HR, let's say payroll software, well, maybe your AI model will just give you that for free because you're buying other services from them. So I think you're going to see, and you're already seeing it, excuse me, a collapse in the number of software vendors and software products that enterprises use. That's being played out certainly in the private equity market, private debt markets, being played out in public software stocks. Where I think the market is probably overshooting is Jevons paradox will be at play, which is when a new technology comes along and you think it's going to displace something, it actually creates more demand for it. So if in 10 years we all have personal robots in our house, the robot's not going to cook a chicken in its stomach. It's still going to use your oven, right? So you're going to have I think, an increase in usage of software, but it's software where you're really buying the domain expertise. You're buying longitudinal data. In other words, to get economic data going back more than 50 years gets really, really expensive. So AI is useless without data. So those companies with software that have domain expertise that can't be duplicated by AI, they'll be able to use AI to improve their product and improve the ROI for their customer. So I think there'll be, I guess when it all washes out, it'll be clear winners and losers. But right now it's nuanced, and the market's having a really hard time differentiating, and that's where opportunity arises.
So that's perfect. And I think, so we have a few questions coming in that are really related to what I'll call the physical economy.
Okay.
So other areas that are building up to support or ramping up to support the AI build out, or even this new regime shift that we're talking about. What areas do you feel would possess durable advantages or may possess durable advantages?
Yeah, and you can just look and decompose market performance and get a window into this. So what I'm about to share probably won't be a surprise. But if you think back to my comments earlier about the 2010s, what the market valued was capital light intensity. Now, where there's insatiable demand is in hardware. So what we need is physical stuff and stuff that AI can't duplicate, right? AI can't make aluminum. AI can't make copper. AI can't make rocks. So the same rocks used to build a data center in Wyoming are the same rocks used to build the Rome Colosseum 2,000 years ago. So I'll just classify it as capital goods. So to take a step back, yeah, as an organization, we've been overweight that space for as long as I've been here, which is 26, 27 years now. So these were good businesses to begin with. And I'll just describe it as companies who sell mission critical, so really important parts that are low price points to the end product. So a really important sensor that goes into an automobile. So it's a low cost for Ford overall, but they're not going to substitute it with something cheap out of, let's say, Asia. So these are businesses that span across multiple verticals, whether it's commercial real estate, housing, industrials, now data centers. They sell really important goods and equipment that the world needs, whether it's to rearm your military, build a data center, or build homes that the U.S. is wildly short on. I think this a secular bull case for those businesses just because they're high quality compounders, but there's now a cyclical tailwind as well. Now, look, they're not cheap. That comes with the territory, but we think those are going to have been good assets, and they're going to be good assets for a long time.
Perfect. Thank you. So just a quick pause, just to remind everybody to enter in your questions. We have a lot of great questions coming through, so please keep on with them. So Rob, I'm going to switch gears a little bit and maybe talk about some headline news. So we've heard about the ongoing litigation between Anthropic and the U.S. government. Co-founder of SMCI made headline news late last week for all the wrong reasons. And I really think this starts to talk about regulation and what will probably be sort of pending intervention by regulatory bodies into the world of AI, how it's used. Any thoughts on potential impact to rollout, profitability, general impacts?
So that's a tough question to answer because I think AI's impact will probably be far-reaching than in other ways that we haven't even really considered here. I will say though that Lenin said every society is 3 meals away from chaos. Right, so you're gonna miss breakfast. You're gonna miss breakfast and lunch. Oh, I don't like that. You're gonna miss dinner too. Full on chaos. And I'm not suggesting that we're there, except that for the last 20 something years, at least in the United States, you've had a structure that has allowed for the privatization of wealth on the way up, and then the socialization of capital losses on the way down. And you can do that when your budget deficit is 3% of GDP, or you can do that when you're in a low inflationary environment. But if I mix all this together, it isn't just the privatization of wealth on the way up over the last 20 plus years. It's also been the lack of competition in the United States that's really allowed for the transfer of wealth. Right? That's really what's happened for the last 20 years. You've had a massive transfer of wealth from labor to owners of capital, or said another way, from savers to borrowers. Now, it doesn't sound like I'm answering your question, except to the extent that I don't know if we're at lunch, if we're missing lunch, or we're missing dinner, or we're somewhere in between. But there's a major rally coming here in Boston on Saturday. It's part of the No Kings effort, and it's going to be so you're just getting to that point where the people are getting angrier. So it's my way of saying I think you're going to see a lot more regulation in Internet 3.0 than you did in Internet 2.0. One, because the technology is far reaching, but two, I think you just have a lot of people who are unhappy and have been made promises by both administrations, Democrat and Republican, that have gone unmet. And I would expect a lot more change to come. If you just look at some of the election victories in the United States just here in the last 2 years, it's just getting more and more extreme. And with that, I think comes more outcomes, which, to bring it back full circle, ring fences the importance of it's going to get harder to deliver returns that investors have come to expect. So the product or service better be that good. And that's where all of our attention is focused, because we ultimately can't underwrite what the competitive environment will be from a regulatory standpoint, or what policymakers or lawmakers will do. But we can underwrite is, all right, what does this company do? What's the cost of doing it? What's the total addressable market? Can somebody else do it? If somebody else can do it, it's probably not going to be a good business.
Okay, great. So really interesting question here that sort of ties into that, maybe takes things from a little bit more global perspective. We look at the build out of AI, and we'll compare and contrast. And I'm sorry, I'm paraphrasing here, but North America has tended to be more of a high end technological build out, whereas if you compare that to China, it's been more of a state led rollout. It's focused in, if you want to pick a couple of areas like industrials and manufacturing, about early adoption and widespread inclusion or adoption. So are we talking about, one methodology is winning out over the other? I mean, ultimately it's it's about profitability.
Yeah.
Any thoughts on how this will play out?
Yeah. So I think China's version of capitalism prioritizes control over profits. America's version of capitalism is the exact opposite, right? It prioritizes profits over control. My guess is the two countries will be less far apart as the years progress. So, what's China's problem? China's problem is massive deflation. But they have significant deflation, massive overinvestment in property, and huge overinvestment in the ability to produce elite machinery with very immense competition. So all of that has contributed to a deflationary spiral. So that's problem number one for China. Conversely, what does that provide? Well, BYD has a car that's as good as Tesla's, if not better, for a third of the cost. China's AI models, they're not as good as the US's. They're getting close, but it's done at a fraction of the cost. So what I think about China's long game, or their willingness to accept near-term pain, significant deflation, and why the stock market's been poor. It was strong last year, but generally speaking, because you had deflation and very low profits. I think what's interesting now is quietly they're embarking on I forget the Mandarin word, but it's what they call involution, which is allowing businesses to fail. So I think there's a clear change towards prioritizing profits, because they need to create profitable companies that can create jobs and get them out of that deflationary spiral. Whereas in the US, we've had a system that has prioritized profits, but it did so largely through globalization, through cost cutting, which is why now you have this huge, massive wealth inequality gap between labor and capital. So each have, and you have now inflation because we have all these goods that we're short on. So each country has two distinct problems that are very different. And I don't know how it washes out, but back maybe to the spirit of the conversation, I got asked in the hallway here earlier by someone in the sales department, views on large cap versus mid stocks, and aren't mid stocks poised for better performance? And I said, I don't know. I don't have high conviction in that. What I have high conviction is whether your company is based in China or if they're large cap or small cap, what matters is their ability to source inputs into production, whatever that is, and then what's the demand elasticity for what it is that they sell. If it's highly inelastic, in other words, if they keep raising prices, but demand is supportive, then they're going to be able to protect margins, and it's going to be a good stock. And so I think if we sort of zoom out, less about where the company operates in the region, less about its market capitalization, or if it's growth or value, or if it's Canadian or US. Do they have something that's going to be fit for purpose in a very, very different world? And that'll be a good business. That'll be a good stock.
Great. Thank you, Rob. So we have a few questions here that I think if I paraphrase them, I just wouldn't do them justice. So if you don't mind, I'll
Sure. Go
read
ahead.
them out to you. Okay. There was a report by Goldman Sachs that said, despite all those huge investments made by big corporations on AI, The net effect on US growth was essentially zero last year because they were mostly used by imported machinery and equipment, which netted out the investment made.
Yeah.
Surely they had some positive effect, but overall, no real contribution on real economic growth. Do you agree with this assessment? And do you think that this trend can be sustainable to continue this capex without contributing positive growth on the economy as a whole?
So I'm not an economist, so I'm really not equipped. I think I know that report that the person is talking about. I'm not an economist. To me, that's just an accounting measure. So how do you account for GDP? Right? GDP is C plus I plus G plus the delta between imports and exports, right? And the C is 60 something percent. The G government spend is 18, 20%, maybe higher now in the US. C plus I plus G. Oh, CapEx, that's 10 to 15%. So CapEx is a small portion of the overall GDP. So I think Goldman's probably right, and their economic team is pretty good. I think, to me, the bigger takeaway, right, is for the last 15 years, you had the only economic growth you had was in 2021 due to $5 trillion of fiscal stimulus. So I think, the pathway for GDP, it's going to be a function of population, labor market health, productivity, immigration, those factors. For me as an investor, I just care about how many cups of coffee is Starbucks going to sell, at what price, at what cost, and then what multiple should we put on that. And so as it pertains back to these AI companies, they're spending exponential amounts of capital, and it's not finite, it's infinite. So as we use AI more and more, yes, MFS is going to have to pay that AI provider, but they're paying someone else more for that compute. So I think the value of AI will shift away from the model deliverers to the companies with domain expertise, the specific software companies that I mentioned earlier that can use these AI models to improve the ROI for the enterprise. So sorry, I don't have a very good question for that because I'm not an economist. But to me, it ultimately, if we're just talking about the equity market, all that really matters is return on capital and the multiple. And I think there's a lot of businesses where the returns on capital are unsustainably high and the multiple's too high.
Perfect. Thank you. We've got another one here that touches on, we touched on it earlier, the physical assets. But this one more specifically, we're seeing a massive rotation from traditional office and retail investment into AI adjacent real estate like specialized logistics, cooling intensive data centers. Do you view this as a sustainable structural shift, or are we repeating the capital allocation mistakes of the past by over concentrating private wealth into single high cost physical assets?
Yeah, great question. I think the answer is no, from the standpoint of when capital is deployed, it needs to create the utility to justify that capital spend, right? So in other words, if you invest in a project and the estimated return on capital is 7%, if it delivers 3%, it's a failure, or maybe it delivers 10 and it's a wild success. So for those REIT operators that are building facilities or leasing out facilities to a hyperscaler, I think that's a viable construct that has a long duration of growth. Now, you could argue the counter to that would be, well, ultimately all these data centers are going to be hitched to satellites in space, and there's some scientific problems with that. How do you cool them? So maybe that's a few years out, but I think the trajectory of growth for data centers, particularly when quantum computing, we're probably a couple years away from that. Nuclear fusion, probably a couple years away from that. And then humanoids, so actual robots. So the demand for chips and data centers and power, all that, it's not going to decrease. It's going to increase. So I think that capital being deployed is probably being deployed for a utility that pays for itself.
Perfect. Thank you. So, and just a reminder, everybody, we're coming up close to time. If anyone does have any other questions that they'd like to ask of Rob, please don't be shy. Drop them in the chat. We can also open up the Q&A if you prefer to ask Rob a question virtually. We're more than happy to do that as well. But there's one last one here, Rob, that I really kind of like, maybe a little bit tongue in cheek, given the fact that we opened up asking the question, are we asking the right questions? This one is there a question we should have asked that we haven't?
So great. Gosh. Well, I'm going to answer it this way, and I don't know if this is helpful or not. So I've been doing this for maybe over 30 years. Yeah, over 30 years now. And for the first 26, 27 years, I'd say 2 out of every 3 client questions were the same. And it was largely on current events. And then 1 out of 3 were very idiosyncratic. So, maybe a Canadian pension plan will have a different question than a financial advisor in Taiwan. And since 2022, in my experience, every question is the same. So, as you know, we have these prep meetings before a client meeting, the media team. So when I square off with, someone who is writing an article for Bloomberg or whatnot, we have these prep meetings, my response, as has been, I know what they're going to ask. And that, to me, is possibly a signal that whatever is going to take a bite out of financial markets is something none of us are talking about. Because you never, in my experience, you don't see the bullet that hits you. I do think ultimately all that matters is return on capital, profit stream, profit margin, however you want to think about it. And the multiple people are going to pay for that. But the spark that lights the fire is always something out of left field. And the kindling for that fire has already been laid, right? Which is businesses that got really, really fat from a profitability standpoint on cheap labor, cheap capital, underinvestment. All that's changed. And what exposes that will get the blame. Maybe it's this war, or maybe it's something else. But that's not the reason for it. That's just exposing capital that was already destroyed. So I don't know if that really answers the question, but the future has no facts. It'll probably be something out of left field. And at least for us, for me, you need to be prepared before that happens. And to me, being prepared, that means owning assets, financial assets, where the ranges of profit outcomes are narrow versus really, really wide.
Perfect. Thank you. And I think maybe we have time for one last question here. And again, I'll read this one out. A lot of private equity buy and build strategies in the middle market rely on software to drive operational efficiencies and defend their margins.
Yep.
If AI further lowers the barriers to entry, effectively commoditizing the services these portfolio companies, do you think the industry needs to rethink its entry multiple assumptions?
So yes, yes to all that. I'll give maybe a more simplified answer, which is Wall Street has a history of storytelling. And what leads to disappointing financial outcomes is when the cash flows don't manifest or aren't manifested, that doesn't line up with the story. So for example, after China entered the WTO 20 some odd 30 years ago now, a massive bull case story was told by every emerging market strategist of rising middle income class, greater economic growth for EM countries, and EM equities were going to be secular outperformers. The first two things happened, the third did not. So EM countries had wildly superior economic growth. If you take China's economic growth from the early 1990s to today, it was close to 5,000%, massive, versus the United States at 400%. But US equities were up 30x, and Chinese equities were up 7 or 8x. So it's not GDP that drives stock prices, it's profits. So many investors plowed money into emerging market equities because they bought a false narrative that economic growth would drive higher returns on capital for EM stocks. This pattern plays out time and time and time again. And there's tons of great books on that. My favorite is Devil Take the Hindmost by Ed Chancellor. Anyway, as it pertains to private equity and debt, I think the same thing existed where you had, let's say, the Yale model and really high information and Sharpe ratios. And at the same time, coming out of 2008, bank lending went away. So you had high increase storytelling that private was less risky with higher return, and increasing demand from the customer base with very little supply. And so what happened was you had just this massive avalanche of demand that exceeded supply. And what always happens in Wall Street is demand creates supply, not the inverse. And so I think the problems you're seeing with private equity and private credit today are twofold. One, you've got this new technology that's disrupting 1/3 of the companies where capital was allocated to software. And I think there'll be some software businesses that thrive and others that die. But two, I think ultimately it was just Wall Street storytelling and demand that exceeded supply. And that will correct or is correcting.
Fantastic. Thank you, Rob. And right at time as well. I think we've cleaned out our queue in terms of Q&A. Maybe I'll just take a quick moment here to extend our thanks to the CFA Society Winnipeg for hosting us today. Rob, thank you so much. This was really insightful. Great conversation. I'd like to thank Harry Singh for his time and efforts putting this together, as well as Eva Swan and Amra Jakupovic. So with that, Harry, maybe I'll turn things over to you.
Thank you. Thank you, Andrew. Thank you, Rob. Just on a quick little note, this presentation was recorded and this discussion was recorded, and we will be posting it on our YouTube channel within this week so that you can watch it. And if you have any questions for Rob or Andrew, please feel free to send them over to us at info@cfawinnipeg.ca, and we'll be happy to get those answered for you. But once again, thank you so much, Rob and Andrew, for making this such a fantastic event. I learned a lot about AI and your thoughts around what are the trends. Um, Please watch out for your inbox. We have some other events coming up very shortly in the next couple of months. And hopefully we'll see you there. Thank you so much and have yourself a great day.
Take care.
Great.
Thank you all.
Thank
Thank you.
you.